Market Overview, a resilient yet vulnerable landscape. As we step into October, the financial markets have just emerged from a surprisingly positive September, a month historically known for volatility and downturns. The S&P 500 hit a new record high, defying the typical seasonal weakness. However, the tide appears to be shifting with a confluence of global and domestic headwinds threatening the sustained rally we've witnessed over the past year. Rising geopolitical tensions between the US and China, global economic slowdown concerns, valuation pressures, a softening jobs market, and persistent inflation are all casting shadows over investor sentiment. Despite the market's resilience, largely driven by the Magnificent Seven mega-cap tech stocks, there's a growing consensus among investors for a reset. This isn't about predicting a crash or recession, but rather a much-needed correction that could pave the way for fresh opportunities in undervalued sectors and stocks. In this analysis, we'll dive deep into the current market dynamics, explore historical context, and highlight 3 stocks poised for potential dips that could offer compelling entry points for long-term investors. These picks span diverse sectors: industrials, healthcare, and technology, reflecting the need for diversification in uncertain times. Let's unpack the broader market environment before zooming into specific opportunities. Historical context: September strength and October uncertainty. September has often been a challenging month for equities, with data from the past few decades showing an average decline of about 1% for the S&P 500. This pattern stems from seasonal factors like portfolio rebalancing and profit-taking ahead of year-end. Yet this year's positive close signals the market's underlying strength, fueled by robust corporate earnings from tech giants and optimism around potential Federal Reserve rate cuts. Since the post-COVID recovery in 2020, the market has climbed over 80%, with the S&P 500 gaining approximately 17% in the last 12 months alone. However, October brings its own set of historical baggage. Known for some of the most infamous market crashes, think 1929 and 1987, it's often a month of heightened volatility. With current global tensions, particularly between the US and China over trade policies and technology restrictions, and domestic concerns like inflation hovering around 3.2% as of recent data, and a cooling labor market, unemployment ticking up to 4.2%, the stage is set for potential turbulence. The reliance on mega-cap tech stocks to prop up indices like the S&P 500 and NASDAQ also raises concerns about market breadth. When only a few names drive gains, a stumble in these leaders could trigger broader sell-offs. Global and sector-specific impacts. The escalating US-China tensions are more than just headline noise. They have real economic implications. Tariffs and trade restrictions could disrupt supply chains, particularly for tech and industrial sectors, increasing costs and squeezing margins. A global economic slowdown, evidenced by weakening manufacturing PMIs in Europe and Asia, further complicates the outlook for export-driven companies. Meanwhile, rising inflation continues to pressure consumer spending, a critical driver for sectors like retail and hospitality. Sector-specific dynamics are also worth noting. Healthcare, often seen as a defensive play, has underperformed over the past year, with the S&P 500 healthcare index down roughly 5% compared to the broader market's 17% gain. This lag reflects patent expirations for blockbuster drugs and investor preference for growth-oriented tech stocks. Conversely, industrials like aerospace face unique challenges, reputation risks, and operational hiccups, but benefit from dualistic market structures that provide a wide economic moat. Technology, particularly niche players in fintech and cloud solutions, remains a high-growth area, though tied closely to economic cycles and consumer confidence. Opportunities amid the reset. 3 stocks to watch. Against this backdrop of uncertainty, A reset could create buying opportunities for discerning investors. Below, we analyze 3 stocks across different sectors that are high on the watch list for potential dips, offering a blend of value, growth, and defensive characteristics. 1. Boeing. Industrials with long-term tailwinds. Boeing, with a market cap of $168 billion, has endured a tumultuous few years marked by high-profile accidents and operational mishaps. Yet recent leadership changes signal a turnaround. Shares are up 61% in 3 years and 20% year-to-date, reflecting renewed investor confidence. Operating in a duopoly with Airbus, Boeing enjoys a wide moat, insulating it from competitive pressures. Analysts project a significant earnings recovery, with EPS expected to turn positive next year and grow by 86% in 2026. Trading at a forward PE of nearly 60, the PEG ratio below 1 suggests the growth justifies the premium. Buy target? Around $180 to $207. A dip to 180 would offer an attractive entry, especially given the stock's potential for further gains over the next 12 to 24 months as reputation repairs and order backlogs drive revenue. 2. Merck, healthcare value play. Merck, a healthcare giant with a market cap of $218 billion, has lagged recently, with shares down 5% in 3 years and 15% year-to-date. The looming patent expiration of its top drug, Keytruda, in 2028 has spooked investors, reminiscent of AbbVie's challenges with Humira. However, Merck is diversifying its pipeline, and analysts expect EPS growth of 7.5% next year and 9.4% in 2026, trading at a forward PE of just 8.9, a bargain for the growth profile. The PEG ratio of 1 further underscores its value. Buy target? Around $80. Current levels already offer a low-risk setup, but a further drop to $80 would enhance the risk-reward ratio, especially for defensive portfolios. 3. Toast. High-growth tech for the restaurant industry. Toast, a cloud-based platform for restaurants with a $22 billion market cap, represents a higher-risk, higher-reward opportunity. Shares are up over 100% in 3 years and down 5% year-to-date, reflecting volatility as a relatively new public company, IPO in 2021. With strong revenue growth and a first profitable year in 2024, Toast is capitalizing on the restaurant industry's push for efficiency. Analysts forecast 24 to 26% EPS growth over the next 2 years, with a forward PE of 29.9 and a PEG ratio of 1.2. Its reliance on consumer spending makes it vulnerable to economic downturns, but expansion, adding 7,000 new locations in a single quarter, signals robust growth potential. Buy target? Around $32. With an RSI near 20, indicating oversold conditions, a dip to $32, about 10% below current levels, would be an ideal entry point for growth-oriented investors. Investment and policy implications. For investors, the current environment underscores the importance of diversification, not just across sectors, but also across investment platforms. Spreading capital across different brokerages and asset classes, like stocks, ETFs, and options, can mitigate risks tied to market resets. The 3 stocks highlighted, Boeing, Merck, and Toast, offer a balanced approach. Boeing for industrial stability, Merck for a defensive value, and Toast for growth. However, timing entries during dips is critical to maximizing returns, especially given potential near-term volatility. From a policy perspective, the U.S. government's handling of inflation and geopolitical tensions will be pivotal. Continued rate hikes by the Federal Reserve to combat inflation could pressure growth stocks like Toast, while trade policies impacting supply chains could hit industrials like Boeing. Investors should monitor Fed minutes and trade negotiations closely for directional cues. Near-term catalysts to watch. Several catalysts could influence the market and these stocks in the coming weeks and months. Federal Reserve decisions. Any signals on interest rate cuts or pauses could lift sentiment, particularly for growth stocks like Toast. Earnings season. Upcoming quarterly reports for Boeing, Merck, and Toast will provide clarity on operational progress and guidance, potentially triggering price movements. Geopolitical developments. Escalations or resolutions in U.S.-China tensions could sway industrials and tech sectors, impacting Boeing and Toast. Economic data releases. Jobs reports and inflation data will shape expectations for consumer spending, directly affecting Toast and indirectly influencing Merck's defensive appeal. Conclusion. Positioning for the reset. The market's resilience over the past year, driven by a narrow group of megacap stocks, masks underlying vulnerabilities that could lead to a healthy reset. While a crash or recession isn't on the immediate horizon, the combination of global tensions, economic headwinds, and valuation concerns suggests caution. Yet within this uncertainty lies opportunity. Stocks like Boeing, Merck,